Master your debits and credits. Brought to you by the Debits and Credits Trainer. You can buy it for just 99 cents on the Google Play Store. This is a T account. T accounts are used to visually represent a company's account ledgers. Accountants use ledgers to keep track of each individual account's balance. For example, if you're keeping track of cash, you would keep it in a cash ledger account. So at any point in time, you would know how much cash you have. Ledgers simplify math because increases to that account are kept on one side of the T account and decreases are kept on the other. That way you can add up all increases quickly and then deduct all the decreases quickly. Entries on the left of a T account are called debits. Debit is just another word for left. Entries on the right are called credits. Credit is just another word for right. Some accounts increase with debits and others increase with credits. So it will be important for you to know which accounts are increased with debits and which accounts are increased with credits. Debits on the left, credits on the right. Debits on the left, credits on the right. This is the balance sheet equation. Assets are on the debit side of the balance sheet equation. Therefore, asset accounts are increased by debit entries. Liabilities and equity are on the right side, the credit side of the balance sheet equation. Therefore, liability and equity accounts are increased by credit entries. Decreases are always recorded on the opposite side of an account's increase side. Debits on the left, credits on the right. Debits on the left, credits on the right. This is the expanded accounting equation. It is expanded to show the sources of a company's equity. Equity, which is also referred to as equity financing, is either contributed by owners via capital contributions, or it is earned and retained in retained earnings. When revenues increase, net income increases, retained earnings increases, and equity increases. That is one way to provide equity financing to the business. In other words, how does the company obtain the assets? Either owners contribute it, or the company earns it, which belongs to owners, or they borrow the money. This is debt financing. But when expenses increase by recording debits, that debit will cause a decrease in net income. And that decrease in net income will cause a decrease in retained earnings, and that decrease in retained earnings will cause a decrease in equity. And when dividends increase by recording debit entries, that increase in dividends will wind up reducing retained earnings and reducing equity. I've put in the other decrease indications for the other accounts. Debits on the left, credits on the right. This is a summary table of increases and decreases that we just saw. All assets, expenses, and dividends are increased by recording debit entries. Liabilities, on down to revenues here, are increased by recording credit entries. And the opposite for each of those accounts will be the decrease side. Debits on the left, credits on the right. Debits on the left, credits on the right. So what you can see is, although the debits are all here, some debits increase the given account and others decrease. And the same goes for the credit side. This is what I call the super expanded accounting equation because it includes the rules for all general account categories in my Introduction to Accounting course. It includes contra assets, contra meaning opposite, such as allowance for bad debts and accumulated depreciation. You can see that we deduct whatever the balance is in the contra assets account. So as we increase contra assets, that increase in contra assets will serve to reduce assets on the balance sheet. and contra revenue accounts, such as sales discounts and sales returns and allowances. As more people return their goods, or as they get discounts for having paid for those goods early, the contra revenue accounts will increase. But as you can see, we take revenues minus expenses to get to net income. So as this debit is recorded to increase contra revenues, it will reduce net income, reduce retained earnings, and reduce equity. Debits on the left, credits on the right. Debits on the left, credits on the right. This here are those same rules by account, but now I'm going to add the expanded accounts, contra assets and contra revenues. I think if you'll use these slides and learn these rules, it will certainly help you put the whole picture of the balance sheet equation and the financial statements related to those into perspective. If you're interested in the debits and credits trainer, here are some of the screenshots that will help you record entries and see their impact on the related financial statements.